The health insurance sector has had a very rough 2025 because of higher medical costs and slashing their guidance for the full year as a result of these high medical costs. Also, we've had some pretty big lawsuits against some of these companies for fraud. And as a result of this hardship in 2025, we've seen huge selling in these companies. Now I'm going to be taking a look at the biggest player of health insurance, UnitedHealth, which has earnings in about 1 week. So I'm going to be taking a look and seeing what we should be doing before their earnings and potentially after their earnings. As we can see with this ETF, which is the iShares US Healthcare Providers, we can see that in this past year, it's down over 20%. While the stock market's up over 5% and at all-time highs, U.S. health insurance companies have had a very rough start. But let's first look at other companies that have just recently had earnings in order to give us a sense of how the space is going and what we should expect for UnitedHealth and what we should do with the company. So, firstly, we have Elevance Health. We can see Elevance Health right here, in which Elevance Health actually had some good revenue numbers, in which they had $49.4 billion in revenue, which was a revenue growth rate of 14%. So this company is really growing their revenue growth pretty good, and this is no sign of slowing. However, the biggest problem with these companies is their earnings per share, which they reported earnings per share of $8.84, which did miss slightly, but it didn't miss by that much. The problem with Elevance Health is their higher medical costs, in which they revised their full year diluted EPS guidance to approximately $30 per share, in which analysts for 2025 actually expected this number of $30 of earnings per share to be about 35. So this was a pretty big shock, and as a result of this unexpected slash of guidance, we can see that over the past month, the stock is down over 25%. But if we go ahead and take a look at Elevance Health earnings per share, we can see it is growing over time, and they actually expect this to be $30 of earnings per share this year. So with that being said, we should see this actually continue to increase over time, and it should be up about right here where this cursor is. So with that being said, although they did cut their guidance, they're still expecting some good growth, which doesn't make sense for the stock to be down so much, because I do think that Elevance Health has been going down as a result of these other health insurance companies going down too. So with that being said, Elevance Health earnings didn't even look that bad. But today we did have Oscar Health, in which Oscar Health is actually up during the day about 1 to 2%, which looks pretty good. However, management actually said that they expect a $230 million loss from their operations, in which analysts expect them to actually make money. So this doesn't look good for Oscar Health, and I would definitely be staying away from this company. But nonetheless, this gives us a good overview of the sector right now. Also, Oscar has revised their full year 2025 outlook. The company now expects about $12 to $12.2 billion in revenue. So once again with the revenue, if we go ahead and take a look at the revenue of Oscar, we can see that is still good growth in the company. So the problem with these health insurance companies is not the revenue. Their revenue growth is still growing at almost double digits for most of these. The biggest problem is their profit margin, in which, as we can see, as a result of these profit margins, they actually said they're going to have a medical loss ratio of 86 to 87%. So this is very high medical loss ratio, in which this is going to result in decreased margins, and this is why they're going to be losing money. And this is the biggest problem with these health insurance companies. They're having worse margins and also a lot higher medical costs. Also, another problem is for the companies such as Oscar and Centene, which they are mainly government-funded programs, in which if they don't get the government funds, and which they are actually reducing these government funds, these companies are going to suffer because they're going to be making less revenue. But nonetheless, I think the reason the stock is up today is probably because this is not as bad as people thought. Even though they're expecting a loss from their operations, it's still not terrible from Oscar Health, in which I think, and the problem with these stocks is that the prices are almost baked in to the point that they're expecting no growth out of these companies, in which I think this could be a good time to buy these companies. I think this is a slight little hiccup in the road for these companies, and I think in the future they could be perfectly fine. But Wall Street is selling, and there's big panic right now with these companies. But this is the time to be buying as a value investor. So now getting to UnitedHealth's earnings, in which this is very important, in which they have earnings on July 29th, 2025, in which This is going to be a very big earnings for the entire industry, not just UnitedHealth, which UnitedHealth does expect, analysts do expect them to decrease in earnings, in which they expect about $4.94 per share, which this would be significantly lower than the $6.80 reported in the same quarter last year. So once again, with these companies, they are expecting a lot lower profit margins. However, the good thing is analysts do expect growth from these companies still, with the expectations of EPS reaching $26.40 as of 2026, meaning UnitedHealth is going to be trading at about a 10 to 12 PE ratio. And in 2030, they're actually expected to have $45 of earnings per share, meaning if they trade at, say, a 15 PE ratio, I could see the stock anywhere from $600 to $700. And this is going to be the big determination of UnitedHealth. I think UnitedHealth is actually going to be up on earnings. And the only reason I say this is because I think UnitedHealth is going to post okay earnings, or probably bad earnings. But I think it's going to be better than what people expect from UnitedHealth. So that's the good thing about UnitedHealth. And with that being said, I'm going to take a look at the revenue growth rate of UnitedHealth, in which, as we can see, like all these other companies, they're growing at a pretty good rate, almost double digits. So that's the good part. But taking a look at the earnings per share of UnitedHealth, we can see it was growing at a pretty good rate, but as of recently, it's been pretty all over the place. But the good thing is analysts still expect 2026 to be about $26 of earnings per share. So they're still expecting growth in the future. So with this big hiccup, I think this could be a good time to be buying these companies. Now I'm going to be taking a look at the intrinsic value calculator for UnitedHealth, in which the first thing I have to do is look at the annual revenue growth rate in the future. So UnitedHealth has been growing their revenue growth rate very consistently, anywhere from about 5 to 10%. So I think a fair revenue growth rate for UnitedHealth could be 7%, in which in the next 10 years, I think they could get about $806 billion of revenue. So now for the future profit margin, this is where it gets kind of tough with UnitedHealth. Taking a look at their profit margins right here, we can see that it's been all over the place basically, but in 2024, we saw a huge dip, which makes sense, which is why the net income was down a lot there. But UnitedHealth has been anywhere from 6% all the way down to 3%. So this is where it gets pretty hard for UnitedHealth, in which do I think that in the next 10 years, UnitedHealth will be at about 6%? I would say probably not, but I think that they could get to 5% on a conservative basis. So let's put in a 5% net profit margin for UnitedHealth, in which I think they're going to make $40 billion of net income in the next 10 years. Now for the future PE ratio. UnitedHealth companies are growing at a slower rate compared to the stock market, so that automatically gives us a discount to the 25 PE ratio of the market. But most of these health insurance companies trade at anywhere from 5 to 15, in which UnitedHealth is trading at about a 12 PE ratio right now. And I think in the past they were at about a 25 PE ratio. So I think a fair PE ratio is 15 for UnitedHealth. Now for the shares outstanding. Each year, UnitedHealth has been buying back shares at about 1 to 2%. So I think they're going to be buying back shares at about 1% each year. And with this being said, I get a future share price of UnitedHealth at $728 per share. And right now we're at about $280, in which I think if you bought this today with these assumptions, I think you can make about a 16% return. But here's my game plan for UnitedHealth. I'm going to be waiting for this earnings report in about 1 week. If it comes out that it is not as bad as expected, I'll be waiting to see what price I'd be willing to pay. I think UnitedHealth could be a good buy soon, but I would be waiting a quarter at least to see what they're going to say for the future of this company. So thank you guys for watching this video on the health insurance industry. Please subscribe, hit the like button, comment down below what stocks you want me to analyze next, and thank you.